look, it's the portion of these bets that are not physically directly hedged with physical that is going to blow up.
There's a lot to talk about during these historic times, and we've got Andrew Maguire in the house, and he'll be talking gold. This is going to be another amazing episode, I know, so fasten your seatbelts. Andrew, we usually start off the episode by talking about what's happened since our last episode, and we focus on, of course, the all-important battle that we're evidencing between the paper market and the increasingly compliant Basel III physical drivers, and with the unanticipated geopolitical drivers still being assessed here. Can we maybe pick up on the thread on this?
Yeah, absolutely, Shane. Nice to see you again. I think the first thing I want to say is, look, and I said it last time, our hearts go out to everyone unfortunate to be caught up in the misery of a real hot war. And the official narrative around the blowback effect of the sanctions that are having on the West are deliberately watered down, and so that's what really kind of what we're focusing more on, that side of things. And really, what we're leading to here is an inevitable upcoming gold revaluation. It cannot be ignored. So let's look at the fight between the paper and physical markets and how to really to position ourselves in the short and the long term, which is kind of what we like to do each time. But this is pretty dramatic now. Now, stepping back from the strategically gamed intraday, intra-week gold and silver market chart chatter, and you can see it behind me. I mean, you see it on your charts. What it actually reveals is that World War III is being played out in the gold market. World War III won't happen with a nuclear bomb. This is being played out in the gold market, and there's reasons for that. The Russian and Chinese aggregated physical gold reserves, first of all, they're untouchable. And these real monetary assets, or money assets really, are of sufficient size to bypass crippling sanctions, which is why the US-led PSYOPs operation is now focused on these untouchable physical assets. However, the blowback effect from trying to fight this gold suppression war by selling paper gold into such strong physical demand and the related supply shortages, it's just not realized, nor is it priced in. Now, instead, what it's done is widen the gold window for sovereign and central banks to exchange their debasing dollars for physical gold well below the supply-demand fair values. And long before Russia was sanctioned, Russia had ramped up its gold acquisition strategy. Really, you remember this months back, openly announcing that its national wealth fund was aggressively divesting its dollar holdings. And as part of this process of diversification, they moved to buy between 300 to 400 tons of physical gold. This was published. Now, while Russia has been the most open in their mandate of exchanging dollars for gold, all the BRICS countries are aware that the gold price has been suppressed since Nixon closed the gold window 50 years ago. And all of these countries, without exception, including China and Russia, have been exploiting this hidden gold window for years, stealthily exchanging depreciating dollars for gold. And what was the rush? The game was constant. It was always there. They knew that the Fed would intervene in the gold market consistently, as would the BIS. That changed with Basel III. And we'll look at that in a second. But really, what happened was, with the US employing the so-called nuclear option of cutting Russia's central bank off from SWIFT and freezing their reserves, something that's never happened in history before, it was a wake-up call for China and has incentivized all central banks to both step up and repatriate their physical gold holdings. And we're evidencing this right now. And it's been made absolutely clear that there is an added risk in buying so-called risk-free US treasuries. The US relies on these buyers to finance its ballooning debt. So now countries have to factor in this risk when they do this. And that changes the dynamics of what alternatives does this leave? Well, I mean, gold, obviously, for one. Now, the employment of financial sanctions by the United States as a foreign policy tool was a wake-up call for all countries to diversify away from an over-reliance on dollar-denominated trade. Obviously, it doesn't happen overnight, but gold is the front runner in this diversification process, hence the war on gold. Now, so that's kind of like where we are at the moment.
All right. Well, that's amazing, Andrew. And, before we started recording, you had mentioned Goldman Sachs that was noting a shift in those dynamics that you just talked about. Can you maybe sum it up for us here?
Yeah, Shane, I find Goldman's comments on this subject interesting and actually worth reading. And what they're saying is essentially military conflicts, and this is obviously very recent, military conflicts can be important for currency markets. And quote, we would see geopolitical events as negatively affecting the distribution of possible outcomes for the US dollar over the medium term. So in essence, while there is currently no real alternative to the dollar for capital market depth and global integration, the number of recent events fit with the type of behavior that could start to shift those dynamics. Redenominating a larger portion of commodity trade could be an important step in the process. Now, obviously, there was a long dissertation, but that makes sense. Now, what's really said here is more immediately really what we're looking at here is the logical conclusion of this is a bullion commodity basket-backed currency. That's the next logical step. And obviously, more immediately, as far as as the gold component of this is concerned, while all our well-connected liquidity providers and as well as our own contacts report massive physical gold uptake already, this is obscured for now, obviously, by the extremely counterintuitive COMEX-centric paper gold price action that you can see over my shoulder here. Now, however, it's the EFP flows. Remember, we talked about this multiple times, which is the COMEX price gold credit choosing to convert from a gold credit to a physical position. And that's that conduit where you've got the COMEX position that can actually transit through to the EFP process into an over-the-counter position. Now, what we're specifically focusing on is the Basel III gold credit positions that bypass the rigged the ETF gold credit flywheels. We talked about the ETF gold credit flywheels where they're not Basel III compliant. It is still the one area where you can flywheel gold credit. But it's the part that misses that provides us a very good clue. There is a massive coiled rally coming.
Now, how is Basel III faring into this major geopolitical upheaval here that we're seeing?
Great question, Shane. And I don't hear anyone asking that question. And in fact, we had a Basel III update, I think Monday, as recently as Monday. This week, the UK joined the EU in delaying bank capital rules. However, this does not apply to the $15 trillion a year over-the-counter gold market. Now, the reason is that by allowing paper market dilution to discount gold, it'll just incentivize more countries to swap their unbacked dollars for physical gold at a faster pace. Now, ultimately, the EFP mechanism, where futures price positions can be exchanged for a deliverable spot gold position, they cannot be allowed to break again, like we saw $100 spreads between the paper and physical market back in March 2020 when the EFP conduit broke. That could just as easily be $1,000 spreads into a bid-only market. Now, looking at what happened with nickel just 2 weeks ago, rising 250% in 24 hours until the LME bowed to official pressure and defaulted on these over-the-counter longs, this was a wake-up call for the one quadrillion notional value over-the-counter markets. It was the breaking of this mechanism in March 2020 that forced a nickel-like short squeeze, and while officials bailed out the banks last time, it came close to the too big to fail taxpayer-funded banks to fail. It is very, very close. So to answer your questions, really, Basel III NSFRs were brought in to specifically address this over-the-counter gold dollar drain by forcing over-the-counter longs to roll these liabilities onto their balance sheets, or, go figure, to back these over-the-counter longs with physical gold. Something that wasn't done in the nickel market, clearly. Now we see that the only non-compliant sector flowing through from the exchange for physical transaction as the unallocated gold credit that gets exchanged inside the ETF flywheels. And I've said, please contact your anyone in power, whether it's just the regulators or whether it's your congressman. You should contact them and say, we need to look into these ETFs. And you can quote examples of, say, February 2021, when BlackRock came out and said, well, sorry, no, we're not going to actually buy this physical. We'll just exchange the gold credit, the silver credit, instead of going out to the market and buying the silver, which in good faith, longs had done. So essentially, you've got these kind of defaults going on already, but these are hidden under the table.